on Money FM 89.3. Joining us is Roger Montgomery, Chairman and Chief Investment Officer of Montgomery Investment Management. Hi
nice
there,
to be with
how are
you.
Nice to have you on Money FM. So let's talk about the markets and how the geopolitical uncertainties coming in the next couple of months are really quite baffling. If you're an investor, how would you advise one to manage their portfolio given this challenging outlook?
Well, the right answer is that you don't do anything different. You actually manage your share portfolio exactly the same as you always did. And that is to focus on quality, only invest in high quality businesses, own them while they remain high quality, and only buy them when they're cheap. And if you don't find businesses that are high quality and cheap, then the only alternative is the safety of cash. Now, the majority of companies at the moment are expensive. There's no doubt about that. And the mean company, the average company, is probably 10 or 15% over fair value at the moment. And I'm using the S&P 500 as my benchmark. But that doesn't mean that there aren't good companies available at cheap prices at the moment. So I just gave a talk where I mentioned a company called 51 Job, listed on the NASDAQ, Chinese online recruitment company, amazing runway for growth, opportunity to increase its average revenue per user. They're fantastic. And it's just fallen from about $110 a share to about $70 a share. So there are opportunities like that available in the market, but it's important to remember that the risks are increasing between now and November. You mentioned geopolitical risks.
Yep.
Well, the November midterms are coming up, and if Trump even senses that he could lose power, or any power, in November, then he will put his foot down on that Twitter account much firmer than he has before. So we could see some really crazy stuff come out of the Trump camp between now and November.
All right, well, out of the crazy stuff, if we could wade through the noise, do you see any green shoots emerging when it comes to your...
Well, there's no doubt. Yeah, look, there's no doubt that the US economy, the growth rate up until this interview has been accelerating. There's no doubt about that. It's been a good thing. And that's why we've seen Treasury rates go up. That's why we've seen the spread between BBB corporate rates go up and Treasuries. There's no doubt that that's been the case. We saw the oil price go up, for example. But we're also seeing for example, the emerging market currency ETFs falling. We're seeing copper price falling. So there's an emerging concern that the Fed may not need to raise rates anymore, and that even though they've indicated that they're going to, that the economic growth rate isn't justified or doesn't justify further rate rises. And in fact, we could see the US economy slow down. Now, one view is if that happens, no rate rises, then it's off to the races again.
Yeah.
Share prices go through the roof again. But if the economy slumps rather than just slows, then that could be a risk for corporate profits, and that might mean a recession, and that would be bad for stocks. So we're really in this sort of no man's land at the moment. We're in between, where we don't know whether or not rates are going to continue rising, which suggests the economy is going well, or we see rate rises cease and the economy slows down.
All right, well, with this idea of no man's land in the background, where do you see the best opportunities for investors in the next 18 months?
Okay, so I think volatility is going to pick up between now and this time next year. So in the next 12 months, my personal view is, or our firm view is, volatility should rise. Now, that could be positive volatility or negative volatility. The reason why we think that is because we've got record levels of debt. We've got rising interest rates, record levels of margin debt on the S&P 500, rising interest rates and rising corporate bond spreads. And we've also got this little problem of almost $500 billion US dollars in CCC rated junk bond debt due to be refinanced next year. Now if the appetite for that refinancing diminishes by any amount at all, then some of those companies could go broke, and that could cause a domino effect, which increases volatility. Now, what we know is when volatility increases, the prices shareholders are willing to pay to invest comes down. The PE multiple contracts.
Right.
So we don't need to predict a crash, we just need to predict higher volatility, and that could mean lower PEs. Now, it could mean if record earnings continue for US companies, you don't see any change in the share price. No rally and no correction, share prices go sideways. So I think it's fairly safe to assume rising volatility.
Okay, thank you for your insight. We've been pleased to have with us Roger Montgomery, Chairman and Chief Investment Officer of Montgomery Investment Management, with us here on Money FM 89.3.
Money FM 89.3.